Hi, I'm Joe Ride, a financial advisor with Sage Advisors. Today I'm going to be talking about some time-honored tax-saving strategies that will work for most people if they take these things and do them on a regular basis. What I like to call, don't let the tax tail wag the investment dog. Don't let your tax savings strategies affect your ability to invest money. Some people avoid at all costs any taxation, but it can be at the risk of not achieving the same investment results that you could achieve. Next up is knowing your marginal tax bracket. It's a good idea to be familiar with what your last dime of income during the year is going to cost you. For a couple married and filing jointly, if they make $100,000 during the year, I know that this year they're going to be charged 25% on that income. If someone is single and they make $100,000 this year, they're going to be charged 28% on that income. Knowing your marginal tax bracket allows you to kind of decide whether you should be investing in things that where your income or your capital gains can be taxed, or trying to find some vehicles that allow tax deferred growth. Next tip, calculate your effective tax rate. The way you do this is by taking your total tax bill at the end of the year and dividing that by your total gross income. This gives you an idea of actually the exact amount that your income gets taxed. This is after all deductions and everything like that. Helps you set a budget for what your tax bill is going to be like all through the year so that you can make decisions on how much to budget for other items. Next up, using tax-deferred vehicles as much as possible. What these are your retirement plans through work or an IRA or a Roth IRA. Things like annuities or life insurance allow for the buildup of growth inside the account, and it's never taxed until you take it out. What this does is it decreases the lag of what the taxes can have on your investments over time, allowing for a large amount of growth relative to something that's going to be taxable the whole time. Don't tap your retirement savings until you actually reach age 59 and a half. Avoid this at all costs. The reason is you'll get taxed at your current income tax rate. Plus, you will have a penalty tax of at least 10%, depending on which retirement vehicle you're tapping. So, avoid this at all costs because this can severely cut into the value of what your portfolio is. Maximize as many deductions as possible. A lot of people out there just take the standard deduction on their tax return, but what they're missing out on is a significant decrease in their tax bill during the year if they omit certain deductions that they should have taken in the first place. To avoid this, it's best to run your tax return by a professional. This ensures that you will maximize your deductions during the year. Keep track of your cost basis in your investments. Your cost basis is the amount at which you purchase the investment. This way, when you need to calculate a short or long-term capital gain, you can do that and substantiate it on your tax bill. Folks that aren't able to do this don't necessarily have the ability to calculate a true capital gain and substantiate it with the IRS. Timing is everything. Sometimes you're able to stretch yourself a little bit and make contributions into retirement accounts before the end of the year so that you can maximize your deductions. Plus, for other deductible items on your tax return, if you maximize those deductions before the end of the year and perhaps report income, let that stretch into the new year, you'll have less income in one year and have deferred income into the next year. This can be a useful strategy. Generally speaking, if you want something done right, do it right the first time. This is why I advocate hiring a professional to do your taxes, a CPA preferably. Maximizing your deductions and your credits can have a real impact on the amount you're taxed during the year. If you happen to omit those things doing it yourself, you can't necessarily go back and amend returns and claim deductions and credits that you didn't claim beforehand. If you have to go back and do your taxes over again, you're generally going to spend more to do an amended return than it would have cost you in the first place to hire a professional. Achieving success in investing is tough for people to do on their own. Here at Sage Advisors, we've got the tools and the expertise to make that happen for you.